Okay, good morning, traders, and welcome to this live intraday strategy webinar on SB Trade Desk. Today is Thursday, July 30th. We just got the release of GDP. Second quarter GDP came in at 32.9% contraction for the second quarter. It's a quarter-on-quarter read. Expectations were for a print of negative 34.5, so slightly better than the dismal expectation that we were reading, but still obviously pretty bad. Personal consumption down 34.6%. That was expected at 34.5, so slightly worse than expected there. Core PCE, the Fed's preferred gauge of inflation, coming in at negative 1.1%. We were looking for print negative 0.9. Initial jobless claims coming in slightly better than expected. Continuing claims slightly higher than expected. Good morning to everyone here in the room. I just wanted to get that data out to you as quickly as possible. A lot of people were looking for this GDP print. Look, I don't think it's going to be a major market mover. We were expecting a pretty dismal read, 2 percentage points better than expected, a little bit less than that. But you also missed on personal consumption. You also missed on core PCE, and again, the Fed's preferred gauge of inflation. We also got a downward revision to last month's inflation read from 1.7 to 1.6. Soft readings. Good to be with you guys this morning. DJ, Gary, Jay, we got Kay in the house today, Marcin, Ted, Tiffany, great to see you guys. So yeah, yesterday, sorry I was out. It was good to see, well, it was interesting just to give a quick read over what happened with the FOMC. Not much, right? Pretty dovish. Things are still very, dependent on what's going on with Corona and all the like. For the dollar and the crosses that we've been covering, man, it pushed it even further. Okay, so you have euro just below resistance. We'll hit Kiwi, which is pulling back, Aussie, which is kind of holding resistance, gold, big levels that we just measured out, continuing to hold. We'll look at those. Sterling's at resistance, dollar yen's at support, dollar CAD holding support. Seems like a pretty decent opening range in play. SPX with a pretty nice rebound. We'll look at that and those levels there. I still think the risk is downside for SPOOs. And then we got a pretty strong V bounce in peso. We'll take a look at that as well. Any other questions or trade setups? As always, feel free to throw them on the message board at any time. Let us jump right in. Okay, I'll continue to monitor the headlines here, guys, as they come through. Here's what DXY looked like earlier in the week, guys, right into the Sunday open. Okay, we were, not sure why this chart's not expanding, but we were looking at a near-term support at 94.27 right into the open of the week. A break below that, essentially we're looking for a bigger drop. I'll show you the scalp in a moment. Here's the weekly chart. Here's the weekly chart. I want to bring up the consecutive count indicator again. We've been doing that in every webinar just to show you how many weeks. Okay, this is going to be what, the 6th week for consecutive declines here in DXY. We broke the big level that we were looking at earlier in the week, but that's the level we need to close below. That's the focus. 93.92, 93.88, 618 retracement of the entire 2018 rally, and the outside, the reversal low week close, for 2016. Okay, we broke below it. In fact, we've even made a tag of the next downside level we talked about, 93.23. But the close of the week to keep the downside bias in play would need to be sub 93.88. So keep that in focus heading to tomorrow's close. Also, guys, it's the last day of the month. I almost forgot to even note that. I always bring that up as a red flag. Always a good time to reduce leverage. Always a good time to be a little bit more meticulous with your entries. And kind of just lower the gauge a little bit, lighten the load. Here's DXY on the daily chart. So a break of that multi-year upslope that we were looking at is also in play here. If this is legit, okay, we got to look for a reaction here. That kind of lines up with the need to hold below 93.88 again on that weekly chart, right? So we'll be watching this one closely. Initial resistance on the daily chart, look for that former slope support. Obviously, the yearly lows that came back in March would be the next level on the upside. That's 94.65. Bullish inval. I'm going to go ahead and drop that. to this region here, November 2017 high. If you take a closer look, the actual low day close for March is right there as well. So like 95.07, 95.16. Keep that as bearish in Val. My point is there's room. If this breaks higher above that slope, there's room for a larger recovery. That's not our ideal scenario. Focus right now, support at 93.21, resistance right ahead of 94. Next downside level on the daily chart really exposes the 2018 open. That's all the way down here, just above 90, 92, 92.28. Clean, but stretched. Okay, clean but stretched. So it's not a good time to start loading up on any fresh dollar shorts. Not a good time to start, if anything, if you have anything short, northbound of 94.60 or even northbound of this line, I go break even or better, taking something off here. Stops just above, the 94 swing high that we made back on the 28th here. Look for a pivot here. End of month, thin liquidity market conditions we head into the summer, last couple of weeks here, watch out. Here's what it looks like on the intraday. And again, like, guys, whoop, technicals speak, okay? Here's what the chart looked like. Here's the start of the week. We said watch out for a break. Watch that 93, 94, 27 level right there. Boom, we broke the week. Once that gave out, quick touch of the next two targets, almost in the next 3 days. 93.83, 93.21. Here's the bounce. Look for resistance right there. Now, if this gives out, you're looking essentially for a recovery back right up into the weekly open, back up into the weekly opening range highs. Okay, look what level that comes at. If we're going to fail ahead of 94, again, this rebound would fail ahead of this region. So for a dollar, it's really all about taking profits here, taking a little off the table. If the recovery manifests above 93.88, you start to look for a little bit larger of a recovery, a little bit more of a setback. Ultimately, that'll give us better positioning. But heading into the end of the month, do not get stubborn on this. Do not get cute on this. And don't get too involved, in my opinion. This is just end of month flows here. Not the cleanest setup, but still following pretty nicely. Here's our latest setups. And let's go back to our most recent update. Here's Euro. And here's what it'll look like. I guess this is Wednesday night or Tuesday night. Here's Euro, and here's what it looks like. First, I want to show you on the daily charts and the weekly charts. Here's Euro on the weekly. So, man, where do I start? This is it. This is the big Bahama Mama level we've been talking about for so long. The first region into the start of this breakout was sort of that 2019 open at 1445. We talked about that for a while, right? We failed overhead in March. We failed the initial approach back in the start of June. Actually, the breakout above that 38.2, the first day that we closed above it, that's exactly where we failed yet again. Here was last week's break, surging, right through, back above that slope, which is still continue to offer decent pivots. I'm just leaving it on there. But now we're starting to look at a little bit more objective levels. Here's basic trendline resistance off the 2008 highs. That's not a typo. 2008, 2014. Just missed it. You notice that the parallel that we drew, okay, extending off that 2011 highs, has also been a very nice slope region of resistance. Look where we are now. Okay, there's that slope region right there. You can even, if you wanted to visualize it most effectively, you can even do something like that. Okay, but you get the picture. We're in trouble here. We're not trouble, but it's a big level, all right? So what else is there? In case you weren't just looking at that slope and you didn't really believe in trendline analysis, got a couple of different levels that are really sweet. It's going to be the objective swing high they made back in September of 2018, gives you 118.15. And then, you guys know me, 618 retracement. The entire 2018 decline gives you 18.23. We're there now, okay? The high that we registered so far is 1807. So you got like what, another 7 pips, 6 pips to the upside to cover into that zone. Don't get too meticulous with it, but again, big zone of resistance cannot be ignored. That's the weekly chart. That's the weekly level we need to clear to get this thing going. All right. Euro on the daily chart looks like this. There's that key 618 range. There's that 1815 level. Okay. Even this wide set pitchfork off of the low high low of 2019 and 2020. If this is a breach of upslope resistance, we should see acceleration. We've seen acceleration. This is the now next major lateral level of resistance. Momentum's in overbought territory. Yes, it's curved lower, and the slope of the momentum profile looks like it's heading towards the 70 threshold. But remember, as long as it's positioned above 70, technically the bulls still have it. Okay, so I don't want to start shorting this thing just yet, but I am looking for exhaustion into 118, 118.22, 24, excuse me, 118.22, 118.15, this zone right here. Okay, decent pivot, I guess, at 117.12. I wouldn't remove it. It's just a soft target. We actually closed right there on the pullback, right? So I'm just leaving that level as a pivot in price. But weakness beyond this is what we need to sort of mark, all right, we got a nice stretch. A little bit of a pullback is on tap. That said, it's still a constructive trade, man. We just broke the yearly opening range back here on the 21st. So yeah, you're looking for a late year high. Doesn't have to be, you know, a November, December type of high, but you're looking from a technical standpoint on an opening range break, you're looking for that late, you know, third, fourth quarter high in euro. Questions on the daily chart? Intraday looks like this. All right. So a couple things. Here's the pit, and remember I told you last time that I don't really like when I have, you know, too many slopes in here, because I know a lot of you are super sensitive. Sometimes you don't want to see all of these slopes overlaid, but when they offer guidance, you kind of want to stick with it and see which one holds. So the pitchfork, which we've been working with for so long, that broke early in the week on Monday, and it's held support ever since. Do you see this? 1 touch, 2 touch, 3 touch. Wasn't an actual touch there, but pretty damn close. Okay, and then here we are on the pullback yet again. So I'm leaving that gradient there. It's been offering pivots and price, guys. It's kind of, you know, just leave it on there. The basic slope support, so parallel, 1 touch, 2 touch, 3 touch confirms a parallel extending off the high here. Looks like we tried to break through, tested it a second time. Is that just a raised ceiling? Might have turned just ahead of. Even if it does break higher, look where it starts to converge on slope. 1822, again, that same key 618, multi-year, guys. Massive, massive Fibonacci level. So long story short, I'm on the lookout for entries. I'm on the lookout for exhaustion. My line in the sand is 1850. If 1850 gives way even intraday, it's going to be, in my opinion, humble opinion, it's going to be an accelerated breakout. I don't want to try to fight that. If you get a pretty stern washout, okay, 1621, 1639, weekly open support, former swing highs, a nice pivot that we've been following here at 1621, median line, basic slope support, beautiful spot if we spill lower, where you might want to look for entries, where you might want to look to limit any downside positioning that you have. And we'll look for a reaction there to give us guidance. From here, though, it's either a stab up into this region and failure, or we might not even make it up. If that was the attempt, if we break back below 1720, you know, look for the onset of a larger correction. Excuse me, 1712. Look for the onset of a larger correction. Questions on euro? Okay, so that is euro dollar drifting up towards pretty decent resistance. Keep in mind 18, 15. to 1821. That is euro number 2. All right, Kiwi. Here's what New Zealand dollar looked like earlier. We had finally made a tag, right? Or at least tried to make a tag of that 2019 open, okay? That was 67.05. That was kind of the focus that we were looking at for this last final advance. And that's really where the risk came in. I'll take you back to the Kiwi weekly charts first. Massive region, right? Very much akin to Aussie. You recall that Aussie was coming into its 2019-2020 open objective yearly opens. It broke that, all right? It broke that and probed above. Here's Kiwi. Now, the interesting thing here is that it's a little bit more tidy. Why? Because this is Kiwi's yearly opening range. And an objective look at this price chart, guys, basically shows you if we were to close at these levels right now, some red flags. Looks like you're failing right ahead of objective yearly open support. This year's open is 67.33. We never even made it there. Last year's open is 67.04. We hit that, right? The opening range highs is just a little bit higher for the year. We never quite made that stretch. We did attempt to break this multi-year downslope we've been following, but look what happened on the closes. We're closing, guys, just pips above a 100% extension. Again, we don't know what this is going to look like tomorrow, but I'm just showing you what it looks like objectively from here. Last week, we closed just a hair above that 100% extension. If this was a true break of multi-year downslope resistance, I would want to see a way bigger move than that. If the fail happens at the 100 here, sort of problematic for at least the initial thrust higher. Another kind of counter piece of evidence is, to me, it also looks like it could be a possible 5 wave. 1, 2, 3, 4, 5, which means, again, we could be at a larger correction for the downside before continuation. I do think Kiwi resolves higher in the longer term. Near term, though, again, don't want to be the guy who's trying to fight all these rallies, man, but it looks like we're at resistance. I can't get excited about buying up here. Momentum hasn't even broke 60 here on the weekly chart, on the momentum profile. Very different from some of the other setups that we're looking at. Here's Aussie above 65 already. Here's Aussie breaking its yearly highs, its 2020 open, 2019 open. Again, another indication, another example of non-confirmation highs within related assets, right? Kiwi with a fresh new high, fresh yearly high, breaking resistance, or Aussie with a fresh new high, fresh yearly high, breaking resistance, Kiwi failing to do all 3 of those factors. So Kiwi, watch the weekly charts. If we close back below 66.30, I really think this one's a bigger risk of washing out. Here's Kiwi on the daily chart. There's obvious and clear reason why the downside might be hung here too. And it's because of this lateral level we've been following. The uncovered close, which is now covered, obviously, since this month thrust, was 66.07. The 100 was 66.28. Here's the break, and we've been sitting on it as support ever since. Now, again, we turned just pips ahead of that 2019 open. So if we break and buckle back below this on a daily close basis, yeah, that would be divergence into resistance on a failed break of the yearly, range highs, the yearly open. There's a whole bunch of reasons to look lower if this breaks 67.07 here. Now, even if it does, the pullback we'd be looking to play, the shorts we'd be looking to play, would only be up towards upslope support. So you're only looking for moves like down towards here for now. And then we'd have to reassess. There's a lot of different slopes that we were looking at from the downside that broke higher. So like this zone, not too far off below would be where you'd start to look for a reaction. And that's the tell, I think, if we get it for the break, that'll give us a correction. Otherwise, it's simply a pullback within upslope trend. Here's what it looks like on the intraday. So here's the basic pitchfork that we were following. There was a tag of resistance. We said watch for a break below this zone to mark a larger correction. We're there right now. You haven't gotten a clear-cut break. You haven't even gotten a decent close below. I think you stall a little bit more on this one before you get the move, but ultimately, I think the risk is lower. Again, my humble opinion. Yeah, just look for resistance ahead of that median line. I mean, don't put too much credence on this, but see if it offers guidance. The median line is kind of hanging up here. If it breaks lower, gives you at least an indication kind of where you want to be in time as far as decline. Make sense? Any questions on Kiwi? You're pretty clear on Kiwi data, at least for the next 7 days. So keep your eyes on dollar price action here as we continue to stall right near the early open for Kiwi. Here's Aussie. Might as well look right across the way here. And here's what Aussie looked like earlier in the week. Okay. So the big resistance region, or the big zone that we were looking for reaction, 71.21, 71.31, it's been straddling all week long. It's really annoying. Here's what it looks like on the intraday charts. We broke above, we buckled back below, we broke below, we closed the week below, we opened the week back above and tried to break. It's been sitting as support ever since. Very similar setup to Kiwi, albeit, like I told you, the broader positioning of this same setup is at different zones, with Aussie already having broken its yearly open, its 2019 open, its yearly opening range. That puts key support for Kiwi right back at 70.16 into 70.42, that same zone. So similar scenario, as I would put this one also in a very similar block as Euro. We're testing the 618 of the 2019 range, right? If there's going to be a Fibonacci reaction, we saw the initial reaction last week. This is the weekly chart. We couldn't close above it. And here's this week. Bottom line, watch the weekly close on this. Above 71.31 keeps the long bias viable towards the next major lateral level of resistance. If it closes below, I mean, you're still at risk for a pullback. I wouldn't get too excited unless we break back below this zone, but that's basically the range you'd be looking for if we close sub 71.30. Aussie on the daily chart looks like this. All right. Some slopes we've been following off the low here from last month. Pretty decent, right? Don't really like where we turned. Again, it is divergence into a fresh yearly high, but remember, this is, kind of a breakout, and we got the acceleration when we cleared the yearly range highs, when we cleared those opens. So it looked pretty good. This is starting to look a little tired. Exhaustive trade there, marking a divergent high into, right ahead of resistance. The next big level, guys, on the near-term front on the daily here was 72.06. What is that? It's the late February high. It's the April 2019 high. So right here and right here, really nice lateral level. We turned right ahead of it. 71.31 initial support. Here's what it looks like on the intraday chart. Right? So if this is the exhaustive pump, if this was a failed break at last week's high here and a move lower, weekly open support comes in at 70.82. I don't like how specific on this level, the lateral levels aren't lining up with the slope, but I'm not willing to ditch the slope. It's just too clean, guys. This is just a very simple low, high, low. Really clean support, median line resistance, median line resistance, median line breakout, pivot all along. If this breaks back below 71.21, I'm looking for the larger pullback in Aussie. Any questions here? We do get some Aussie data next week. Keep in mind, into the open of August on the 4th, you have the RBA interest rate decision, and on that same day, you get employment figures from Australia as well. So heading into early August, you will get some event risk into the start of the week, kind of wake things up here. But again, related positioning with Kiwi, where we are in trend, curb your appetite for the long side. We're heading into the close of the month. Big zone. All right, that's number 4. Number 5, and making headlines across the globe, is gold. And it's kind of been a dirty, boring trade for the last 24 hours, maybe. But man, oh man, the levels keep on paying. Here's XAU on the weekly charts. Measured moves for longer term, technical, structures or just measured moves. For the initial advance off the 2015 low gave us the 2618 extension. The 100, obviously, remember here, again, a quick reminder why we stress subsequent extensions. You never want to do that unless you've seen previous ones offer reactions in price. And the 100 was so definitive, both on the 2019 advance and this year's swing low, literally on the mark, had me essentially just looking for the derivations of this measured move. So the 2618, the 1618 gave us a decent pivot. Here's the 2618. Now we turned just pips ahead. It was 1983, I believe the high was 1982, 1981. Okay. Weekly basis, watch this level. Okay. It's not only the measured move, and by the way, anything abroad above 1920 now obviously is all measured moves. There's no previous price action up here to take any kind of reliable, technical approach. It all has to be on the the nature of the advance and measured moves there within. So if we take a basic parallel, this is the same slope series we've been covering off the low. Here's the pivot, break. Here's the decent pivot. You got a little messy here in March, but there was the break. Here's another pivot off the 2017 highs, resistance, 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 breakout. Take it off the 2016 highs. Look where we are right now, right? Could be resistance, could be exhaustion. I don't even want to count how many weeks up again this is. You're in overbought territory, so you don't want to fight it. But if you're looking, or if you're holding long positions, that's a level to look for. If you're flat and you're looking for new positions, not a time to buy. It's certainly a time for possible exhaustion yet again. Here's what it looks like on the daily chart. Way into overbought territory, guys. This is one of the most overbought signals that we've gotten since June of last year. That was just a pause on this stretch before we inevitably just continue to consolidate for almost a month before breaking higher. Point is, curb the appetite for the long side. Okay, take a break. If you're not holding longs, we need to pull back to get back in. If you're really, really short term, you don't have the signal for the short yet, but certainly you're looking for spike highs here, well below 1983. There's so much interest in this trade. Here's what it looks like on the intraday. Again, we don't have real clear-cut levels on the near term, but here's the same chart that we highlighted. Nothing's changed there. Okay, this is what it looked like back on the 28th. We had just tagged that, came back. We drew this slope, and again, real near-term stuff, but we never got a close below. And we never did on this 2-hour chart. You got another test, you got another test, another failed attempt at 1983. Is this legit? Well, if this break is legit, that's the first 2-hour close we've gotten below that slope from July 20th, right? If that is legit, guess what? It should be resistance. Guess what? That resistance now converges again on 1983. So even if this spikes higher to 1983, if this slope has merit, we still should see failure there. Get the picture? My humble opinion, guys. Anything northbound of 1983 is some resumption. 2032. Obviously, the 2000 figure may offer a psychological pivot, either acceleration or pullback, but the next lateral measured technical move is actually 2032, and that's actually derived from the consolidation. There was a multi-week consolidation. Let me just show it to you. Right here. So right here, there was a triangle, because people always ask, where'd you get those levels? Where'd you get those levels? Let me show you. Right? Remember this? Multi-month consolidation to the 2015 low. Boom, boom, off the 2016 low, essentially. Boom, 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 boom. Final breakout Measured move of that was the 100% extension, which gave us a pivot. I can bring it up again, but it gave us a pivot. Secondary measured move of that would be the 200% extension. 2 equal legs of that gives you 2032 on the long side. So just to give you an idea of how these levels are derived, they're not pulled out of thin air. They're all based on existing price action that is based on the nature of the advance, and it all goes back to classic technicals, nothing fancy. People are going to start to derive, okay, a measured move of wave 6 of 2 of 5 of all this nonsense. Yeah, you can do that, and you might come up with the same level. Awesome, man. At the end of the day, there's multiple ways to derive the same level. All that matters is that you're calling the right level. So if we break out here, watch this slope. Here's the same slope I just showed you on the daily chart, on the intraday chart, right? If it does break, that's the next up zone, 2032. Kay says 1983 was a classic call, Mike. Cheers, Kay. Again, not my levels, man. It's the market's levels. I'm just helping you find them. But yeah, I told you, I don't know if I told you guys or not, on the webinar on Tuesday, there was a lot of, you get whenever you break a fresh highs, especially on a commodity such as gold, all the traders in the city, we all like ping each other and group chats and all this, and oh man, a lot of people who don't do technicals are always asking, well, what do we do? There's no measured moves. I guess you guys in the technical arena are kind of lost here, right? Don't think so, buddy. There are ways of deriving levels, and it's all based on market price. So we'll take a moment to toot our horn, but that's it. Let's move on. Cheers, Kay. Hey, Gary says, sorry, Mike, I had to step out of the room for a moment. Have you covered the abomination? No, we have not yet, but it's coming up. First things first, here's sterling, then we'll hit dollar. Yeah, number 6, British pound. We are at resistance, my friends. This is a level I'm looking at. I feel that I've been saying this a lot on sterling, and if you've been listening to me and staying away from the long side, you might be kind of pissed. If you're holding longs, I hope you've been doing something at these levels, because although they are breaking, they are levels that are offering some pretty nice breaks that have been accelerating. So if you take a little off and accelerates higher, you're still holding some of that base positioning. First major level we talked about for super long was 2710, 2754. Took 4 days, finally broke that. Second major level we were talking about for so long was 2840. That only took a single day. We plowed through that one. Next major region, this was this confluence of slope, which we're testing right now, and just hires at 3060, 3097 zone. That's, excuse me, the 618 retracement from the 2019 highs. It's also going to be the March high day close of this year. Okay, so that's your next lateral level. Obviously, still an overbought condition. It's the first, or the biggest, that's the first overbought condition we got this year in sterling. And we've been loving the long side of sterling, but ever since we came into this region, things have been hairy. You look for a decent pullback, man. There's a lot of resistance, a huge pivot in price. This broke, acceleration. Your focus is still on 3060, 3097, in my humble opinion. Here's what it looks like on the intraday. Well, here's what it looks like on the weekly first, to give you a picture. Right? Big breakout. We should have never doubted the breadth of the advance after we closed last week above that major critical pivot in price we've been looking at for years. Well, the next major level is 3070, just higher. 3070. Here's the intraday chart. So this is my problem. Even on the near-term slope, I can't get into any longs over here. Look at this thing. Basic channel. So we didn't have this one here, right? We were working with this channel, and here's what the update looked like. Right? Take away the pitchfork. That's this channel right here. Off the lows. This was the beginning of the week. We opened to resistance. We broke right above that 2816, 2840 level. Channel resistance. Then it held as support. Keeps the focus higher. Break. Pull back real shallow. Test 130. Pull back real shallow. Here's the break again. You got to look for 3060, 3070 in my opinion. Now, if you take a parallel of this same slope and extend it off this high instead of this high, okay, you get that. And what does that mean? Well, it continues to highlight that same exact near-term resistance. I have 3049 as a soft target, guys. It's 3064, okay? 3070 comes up on the weekly charts. You get the whole zone is littered with resistance. 30.97 is actually the March high day close right here. So I guess for Sterling, there's not really much to say here, guys, for new positioning. If you're holding positioning on this, these are levels you want to pay attention to, 30.50 specifically, 30.60, and then 30.70. A 30.97 break, forget about it. You're off to the races for the next upside target, in my humble opinion. That would give you 32. Near-term support, 29.50. That breaks. You're not only looking at a pivot below just the swing high lateral here over the last 48 hours, but it's also that slope. So it suggests a bigger risk is possible for a spill towards 28.40. But for me, it's the same picture, right? Dollar exhaustion on this move lower. So euro exhaustion higher, sterling exhaustion higher. It's kind of what I'm looking for. Again, I want to note that we're heading into the close of the month tomorrow, guys. Do not press this. If you're not already positioned, might be a good time just to take an extended break, okay? Because I can envision a scenario, and I've seen it, and I've been stung with it, where into the close of the month, this spikes higher, rips through these resistance region, everyone's faked out, think it's a breakout. All of a sudden, before the market closes on Friday afternoon, we're well back below, and you're stuck in a position on the outside of the trade. So a note of caution there. All right, abomination. Gary, here it comes, buddy. Number 7. So dollar yen actually have it a very interesting positioning here. Here's dollar yen as it looked on the 27th, right? We had broken the median line. It looked really good. We noted that we were looking for initial resistance here. If we break a larger correction, he never got it. He kind of poked right back above, and then he just rammed right back lower. It was great to see after I came back yesterday from break that we actually went for a tag of the lower parallels here finally. So look, divergence up the yazoo into downslope support. Look at it and address it as such. You're coming off of downslope support. Could you get a rebound here? Sure, but it'd be within the confines of downslope support. Okay, so play accordingly. Um, uh, on a larger scope, dollar yen has actually made some pretty big breaks here. Here's dollar yen first on the weekly chart, right? A pretty big range break that we've held ever since the March massacre, right? The 618 was 105.20. That was the level that we were talking about as initial targets. I still have 2 levels just lower, okay, that are critical as momentum finally presses 40 for the first time this year, okay? Those levels are the objective low from 2018. It was probed in 2019. That's 104.62. And the objective 100% extension of the decline off that March rally, and that gives you 104.12. Both levels, it's the abomination, guys. Both levels of which you could slam into. People are thinking, oh my gosh, dollar yen's finally broken. Here we come, 100. Let's line up. And all of a sudden, 104.60, 104.12, and then all of a sudden we're on the reversal, ripping heads. Just my opinion. Maybe I'm a pessimist with dollar yen, but levels to note: if you're holding shorts on the downside, 104.62 and 104.12, pay attention to those. I'm still basically bearish sub 106.30, objectively from a weekly standpoint here. So while below this level, you're basically looking lower. Okay. Next downside targets. The first was 105.20. We've taken that. 104.20, 104.12. I'm sorry, 104.62 and 104.12. Okay. Here's what it looks like on the daily chart. Objectively, last week was a sheer simple break of the monthly opening range. Here's your monthly open. You set the monthly opening range low on the 10th. You sat in that range all the way till the 24th. You finally broke lower. That shifted, looking for a late month low. Well, you got 2 days left on the month, guys. We registered a low yesterday. My adding to my concern to continue favoring the downside, okay, is that reason. Okay, you've already had a pretty decent 5-day stretch. Yeah, intraday, could it go for another tag of the median line for the pitchfork we've been following off the highs? Yeah, sure, but more of the line of looking for near-term exhaustion. Ideally, if it slams lower from here, you get, again, that 104, the same 2 levels I just highlighted, guys. 104, 60s is what comes up on the weekly chart. I'm actually looking at the swing low here. That gives you 40s, but you get the picture. Curb the expectation here and look for possible exhaustion as you head lower. Here's the intraday chart. Intraday has us at downslope support, like I said at the beginning of the explanation of this setup. I can't make this up. This is objective stuff, you know. Yeah, it's not using the actual high, but look at this touch of resistance, break of support, test of resistance, test of support. I'm going to continue to respect this slope and watch it right now. You're coming off of downslope support on building divergence. I'm long the abomination. It's an emotional hate trade. Gary, isn't it always with the Japanese yen? I don't think I've ever jumped into dollar yen. I guess in my 20s, in my, when I was a little bit more gung ho, I guess you can say. It's always a hate trade for me. Even when it's making me money, I'm kind of in a hate trade. I think it's some sort of emotional trauma we've gone through, Gary. I'm sure there's some counseling for it that can get us through. Again, just as a disclaimer, I have nothing against Japanese people. I love Japanese culture. I got a lot, but their currency certainly tends to rip me up. Okay, so dollar yen coming off down slope support. Look for near term consolidation here. Again, gun to my head, I think you get a little bit of a pop here. Look for exhaustion ahead of the median line if it's going to hold. Next downside targets 104.44, 104.12. Next up, the SPX trade, number 8. That was number 8. This is number 9. SPX. Well, so the downslope we had originally brought to focus here. Did we cover dollar CAD? We didn't cover dollar CAD. Let me do dollar CAD first, and then we'll hit SPX. Dollar CAD looks like this, really big. This is important too. So let me just take a step back. Here's dollar CAD on the weekly charts. All right, big support zone. I showed you guys this on Monday, 33.23, 33.64, absolutely paramount. It's the 618 retracement, excuse me, of this year's range. It's the 50% retracement off the 2017 advance. It's obviously a major pivot in price since last year. We made an outside weekly reversal in September of last year. The breakout of this year was the initial, origin of the breakout. Here's support. Here's support. End of conversation. End of conversation. We've liked the downside of dollar CAD. We've even taken a lot of, sort of short stances off that 37 turn that we made earlier last month. But it was all into this zone, and we really can't do much until we get a clear cut pivot below this zone. Now, my problem here is that even if it breaks, I got this. What the hell, man? What am I gonna do with that? 3250s, right? So even if it breaks this big lateral zone of resistance, and again, take my cursor, guys, and look to the left all through last year, even through 2019, 18 on the advance, big zone. Even if that breaks, talking about multi-year uptrend support, you're talking about former multi-year down trend resistance. Both of those converge right here. Not the best place to be objectively, but you know what? Actually, a really nice place to be into the close, into the open of a new month, because I think you'll get some play here with definitive price action. Here's dollar CAD on the daily chart. Again, there's that 786 retracement. Here's the start of the week. At the end of the day, the weekly opening range never gave out here. Here's your weekly open. You stretch into a low on Monday, Tuesday. Guess what? You're still in that range 2 days later. Near-term resistance, 34.32. That was the level we were looking at last week on the decline. Weekly open resistance, 34.20. We're trading in that zone right now. Bearish invalidation right here, 34.68 into 34.86. 20 pip zone or so. Some major pivots, major swing highs, major swing lows, major swing lows, Fibonacci considerations, slope resistance. That's your bearish inval. So I'm flat on dollar CAD, just as a disclaimer. I don't really, I'm not really crazy about getting something right here. I'm looking for resolution. It's either a buckle below 33.23, 33.20s, and we get this thing continuing, or you see a little bit of recovery here. And taking into account DXY price action, Euro price action, Sterling price action, I am not in the camp of trying to press this shorter or trying to press a short from here per se. So dollar CAD, pretty much throw it in the basket with the rest of the dollar crosses that are coming, some pretty radical and major longer term levels that we need to pay attention to that could kind of curb and interrupt the near term trends we've been following. Questions on Loonie? All right, now SPX. Here's what SPX looks like now. And oh, so by the way, no change to any of the dollar CAD levels, right? Let me just take that back one more time. We simply came, we haven't even touched that 786. We're ranging right above that. And the opening range is now focused on 33.23 support, 34.20, 32 resistance, this zone right here. That's what you're looking for immediate guidance. Bearish inval, bearish inval, no change. Okay. SPX. So this is, remember, if you go to the previous update, this was uncanny. It was kind of freaky how well this worked. We drew on this pitchfork early on, didn't know what was going to happen. We came right into that level. Okay. We pivoted off it, but we finally broke. And what happened when you broke that major lateral level? Again, it's very similar to what you're looking at with dollar CAD and some of the other crosses, right? Even if it breaks, it broke that lateral level, that slope caught it. That slope caught it. And what happened? 2 days later, you're looking at all of a sudden, we're back above that major key lateral level after rebounding off that slope. Had us focused on 32.57 bearish inval. What happened? Well, we ran into 32.57, just beyond that, just be ahead of that rather, failed and moved lower. Said, all right, well, maybe this pitchfork is in play. We finally broke out of it. We finally broke out of it. So it gave you a decent near-term play. Here was the rebound, right? Here was the reversal rather, off of that key zone, pulled back all the way back into support from here to here, even dangled below. Here's yesterday, right? FOMC breakout, pull up, pull back. Still focused on, guess what? That same damn range, 32.19, 32.26. Nothing's changed, guys. We dribbled below it, yes, but now look what happens. Basic slope support connecting those lows. Okay, here's the live chart. Basic slope support connecting those lows, 1 touch, 2 touch, 3 touch. It's converging on the same area. Guys, and this is not some random yearly open. This is this year's open. So as things stand, if we were to close the year right now, SPX has done nothing. Pre-COVID, post-COVID, nothing. We're right exactly where we opened the year. Okay? Pay attention. Pay attention here. Nothing's changed. Levels remain unchanged. I wouldn't stress 32.57 as much. We need a 32.73 breakout to mark resumption or breakout trade. If this is a bear flag, basically if we close below or if we push back below that low that we stretched into yesterday, you're looking for the move into the January lows. You're looking for a move into 31.81. So for me, SPX is at a major pivot right now into the open of US trade. And we just got a release of a contraction. Again, guys, remembering we contracted how much? 32%, 32.9%. We were expecting a contraction of 34. I'm interested to see how the market takes that. Is that good news? Is that good news that we contracted 34? Let's rally. I don't know. Add to that, again, you know me, I don't want to throw and make anything political out of this, but again, we got a lot of, just some things, headlines I was reading this morning suggesting that there's really a big dissension amongst Congress with regards to where Republicans and Democrats stand on a fourth stimulus package, on whether that includes resumptive, added unemployment benefits, the extra $600, what amount that be, or if that continues, whether it includes a tax holiday, whether it includes this or that. I don't even, I can't even keep up with it. It's, at the end of the day, it's all bull. You don't have time to, put that in focus if you're trading. But, whenever negotiations break down, it's not a good thing, especially if the markets are kind of like relying on fiscal aid to try to help this thing out. So, long story short, guys, look for today's close in relation to 32.19, 32.25. That's what I'm looking for to validate either a break or resumptive. If we close back in this range, I'm not necessarily bullish, but remember, everything hinged on this after this outside day reversal last week. That turned us bearish, turned me bearish. I talked to you guys about it on Monday. I talked to you guys about it on Tuesday. I still think the same thing. While we hold that open, I still think the risk is for a move lower after that development. The onset of that would have been a close below the yearly open. We got one daily close below, barely, and we've been doing this ever since. Watch today's close up 32.19, in my humble opinion, would be a nice onset for at least a third leg, to a correctionary stance of some sort. before we move our way higher. All right, that's SPX. Last but not least, peso for the peso traders, number 10. I have been kind of perplexed by this lately. The break looked magnificent. The play looked beautiful. The move below 1350 got me excited. The close below 22 got me super excited. What the heck is this? Look, 2215 was big. It was a 50% retracement of the entire advance of the yearly range. It was the opening range low for the month. Not Mike Boutros' opinion, not SB's opinion. Fact. You had slope in there. So yeah, on this break on the 27th, I definitely got bearish. I told you guys to look for resistance right back at 1350, right back at 15, 2215, 2215, 1350. That was the zone that we've been looking at for so many months, right? Here's peso. That was the big zone. For some reason, this update, guys, there was an update on the site, and the only thing that none of the charts expanded, so I apologize about that. But the levels are still pretty good. I guess if you zoom in, you might be able to see them better. But that was the zone we were looking for. What happened? Well, we broke below it. You saw acceleration, quickly pivoted, and we're testing that as resistance right now. If we close today above 15, 2215, I'm out. I mean, let me say this: it invalidates my bearish bias, and point in fact, it invalidates the bearish trigger that we were given back here in the 27th. So what bothers me with this trade is relative dollar positioning, relative dollar weakness across the board. So, if the dollar is going to rebound in general, maybe this is actually calling, and this is the precursor. Maybe it's going to do that here first. It's going to lead. And if it does, watch for today's close above 115. Here's what it looks like on the intraday chart. And these are sort of the levels that we've been following near term, right? So no change at all, okay? There was the consolidation. There was that break of key support 22, 30, 13, 50 into 1450 into 15, excuse me, 1495. We broke, accelerated. We got 2203.76. You got 2188.97. The 100% extension was just below that. That's right here, teetered, and then all of a sudden, you're marking divergence. There's a couple of reasons to get scared, but then all of a sudden it just jackknife higher. Look, weekly open resistance is 2734. That's what I want to see hold if the breakout is still legit. So if this was a consolidation break, sure, we can go back and test former support as resistance, but I don't want to see anything higher than this. Okay, if we hold the weekly open resistance into today's trade session, you're looking for the resumptive move towards 2182. Again, if we kind of break this, then it could be just something like this, in which case, might be a bull channel. I don't know. Focus for me is whether we get exhaustion today ahead of that region. All right, and that's everything on my list, guys. I feel like I've been talking for hours, but it's only been an hour. So any other questions or trade setups, feel free. Wow, marching. Okay, I can't promise I'll get through all of these, but I will try. Aussie yen looks like this. Man, oh man. Talk about it's as far as I'm concerned, Aussie yen is Kiwi. Is Kiwi. Here's the yearly open, man. You're not only checking the yearly opening range highs, you're also checking yearly open, you're checking downslope resistance, you're checking the works. Below 76.60, this thing is at risk in my humble opinion. As far as like a positioning trade from here, you're kind of mid-range for the month, right? So here's your monthly open, here's your monthly range lows, here's your monthly range highs. You're right in the middle. So yeah, on a broader prospect, looking at this on a daily chart, I do think you look lower. On a near-term prospect, you don't have any positioning here to try to take um, a stab on a fresh trade, right? Here's what it looks like on the intraday chart. Yeah, I remember this. That slope is really ugly, so I don't even want to look at this right now. Yeah, listen, on its face, the simplest thing with this is it's such a coiled tight range. You're just simply looking for an opening range break of the week. Here's your weekly open. Here's your weekly opening range lows. Here's your opening range highs. Look for a break of that. It's Thursday. This is a great. Whenever I see a trade like this, I love to break it out. Super simple. Super simple. You've done nothing since the start of the week. I mean, if you're trading, if you're a real near-term guy, I know guys that trade off tick charts, guys. If you are really near-term, yeah, you're trading this range. For me, I look for a break of this range for guidance. If you see the recovery, right? I'd still look for a 618 stretch, and I'd still look to sell that because it's such a big zone of resistance on the weekly charts. If the break of the weekly opening range happens, look for resistance here, 76, 7620, 7610, this zone. Downside break, I'd have to reassess the targets for you, but you'd look for a formation. You know what I mean? So you'd look for structure for the decline, something like this, right? And then you start to look and target slope and see where slope would kind of come in. Maybe you get another pop higher here and you get another pitchfork formation. But right now, the immediate focus is for a break of the weekly opening range, in my opinion, with the broader risk lower. Make sense? I'm trying to play the flag on the 4 hour. Are you talking about this flag? Could be, sure. I just don't like the formation where you are positioned. For me, I like to trade the positions that are trading closer to either trend resistance or trend support or monthly extremes, the monthly low, the monthly high. I don't really like when we're right in the middle. You don't really have the positioning or the conviction on it. So that's Aussie yen. Your second one was Kiwi yen. Looks like this. Okay, we might have to wait on this. I don't have anything updated on Kiwi yen, although again, from an objective standpoint, I would tell you, just looking at this shotgun approach, I would say that this is looking for exhaustion. I hate that slope, but that would be something to look at. Exhaustion by way of momentum, exhaustion by way of monthly ranges. Here's your monthly open. You're testing monthly open support right now, right here, but the monthly opening range lows come in here. Guess what? That monthly opening range low converges on that long-term 50. So basically, like, that's your big support level. Make sense? Love the outside day reversal. Love the outside day reversal off of the monthly highs, off of resistance. That's stellar. That is stellar. But on this initial pullback, that's your first area that look for interruption. Just basic monthly open. You could get a bounce from here. That's your major breakdown. Watch 69 support. He says, okay, thanks, very helpful. More than welcome, Marcin. Let me get through your rest here. Dollar Swiss looks like this. We've been covering this one. The only reason I kind of hesitated to write about this last night is because the downside break doesn't really, I don't really know what to do from here. This was the level I was looking for as a limit. I was also looking for some sort of support. If we got a bounce, you could have got a better entry to get this final move. From here, if you're not already in it, guys, I don't have anything till 90. 90 to be exact, is the next major support zone. So for me, dollar Swiss, if you ain't already positioned, don't press your luck. It's the last day of the month. If you are positioned, hold on. Hold on to them. This is a big zone. Big zone. Here's dollar Swiss real quick on the Swissy chart on the weekly. I have to run after this, guys. I'm over my time limit, but this just goes to show you how massive of a position this is. Do not ignore 90, 80, 90, 90 on dollar Swiss over the next 24, 48 hours. All right, last one you had was Kiwi CAD. Let me just show you that really quick. New Zealand yen, Swissy, and what was this one? Kiwi CAD, New Zealand CAD. Oof, don't touch this. Don't touch this. Feels like MC Hammer. Don't touch this. This is either a breakout, and it's going to be a huge breakout, or it's a fake out and a half, and this thing's going to slam back into median line support. I think someone asked about this earlier in the week. I was very interested to see if the resistance holds and if it continues to push higher. It's been doing this. So look for this consolidation break, man. If it breaks higher, I think you get a resumptive kick all the way to the upper parallel that can go into 91. If it breaks lower, I was looking at 88 as key support, just because that's, again, your initial yearly opening range highs and the initial monthly opening range highs. That's now converging on slope. That's your major key support zone. My humble opinion is to look for exhaustion on the long side for a move lower. But because we've been straddling and spent so many days above this, I really don't know. I really don't know. Again, pistol to my head, I would say look for the pullback and then look for a reaction at 88 to kind of clear things out. All right. That's all I got. Guys, I hope you had an awesome weekend. Best of luck trading over the next couple of days. Keep it light into the end of the week, guys. Enjoy the weekend, and I will see you for the start of a brand new month. We'll kick things off on the free session on Daily FX, right back here on Tuesday and Thursday on SB Trade Desk. Best luck trading, guys. Have an awesome weekend. Cheers.